New employment confidence figures are out.
A Westpac survey shows employment confidence remains low, around levels seen in the early days of the COVID-19 lockdown.
The flat figures come hard on the heels of a week of numbers spewing from the data sheets of economists around the country.
We got some mixed news on the economy. On one hand, we got confirmation that the economy grew at a decent clip in the first quarter of this year. We saw a growth of 0.8% for the quarter.
New Zealand food and fibre exports are set to hit $60 billion a year for the first time. The rosy outlook is included in MPI's outlook for primary industries report. It includes things like dairy, meat and wool, horticulture and forestry.
Primary industries is leading New Zealand out of the recession that we've been in.
But on the other hand, we've also seen some higher frequency indicators suggesting that the economy might have taken a bit of a pause in May.
Finance Minister Nicola Willis acknowledged today that businesses are still struggling after years of tough economic conditions.
On the inflation front, we saw food prices surge by 4.4% for the year. We've got the economy just bouncing up and down right now.
It mirrors a subdued domestic economy on the back of global uncertainty.
And that global uncertainty just got more unstable.
A senior Iranian lawmaker now reporting that in what they call a decisive response to U.S. aggression against, again, what they call Iran's peaceful nuclear facilities, the Iranian parliament has voted to close the strategically vital Strait of Hormuz.
The Strait of Hormuz is a narrow stretch of water that links the Persian Gulf to the rest of the world. About a fifth of the world's oil flows through it. That's the world's produced oil, the world's consumed oil. It has to go through that waterway. It's largely unavoidable, and so any kind of material disruption would be a big issue.
And with all of the variability that's going on in the Middle East and with oil prices, we can't really be sure about exactly where and when inflation will peak.
Kiwibank economists say while it was nice to have some good news last week on the domestic front, they're holding their horses, pointing out the economy has shrunk by 1.1%, and we're still crawling out of the deep hole we fell into last year. And unfortunately, we may be crawling for some time longer. Don't forget, those March quarter figures are already 3 months old when they come out.
Unfortunately, it's old data, so it predates the trade wars that are going on and the actual wars that are happening, particularly in the Middle East.
It's just, an added risk really to the outlook.
That's Kiwibank senior economist Mary Jo Vergara. I'm Alexia Russell, and today on The Detail, she runs through what the data means and tells us why international instability does us no favours at all.
We'll feel the impact through how markets react to this. And, we've already seen oil surge in the last 2 weeks. I think it's up around 20% since the start of the month. And with this, conflict that just escalated over the weekend, we could see oil prices take another leg higher. There'll be a risk aversion kind of play with a flight to safety among investors, dumping equities and moving into safe havens like gold or the US dollar. So we could see the Kiwi fall off the back of this, and we could see oil prices rise as well this week.
Why is the US dollar still a safe haven when they're basically creating all the mayhem?
Yeah, that's a really good question. And it does seem a little bit like it is going through a bit of identity crisis, with fiscal deficit concerns around the US. So, we haven't seen as much love for the US dollar as we'd expect. But, it is still the world's reserve currency. It's hard to find an alternative at the moment. The euros, strengthened a little bit, especially after the Liberation Day. But, Swiss franc has strengthened a lot as well. But the US dollar still is the reserve currency. So it is catching a bit of love during this time of uncertainty. But there are questions surrounding its status as a safe haven, that's for sure.
It must be really frustrating for people who are pulling the levers on behalf of New Zealand's economy, trying to get inflation down, trying to get growth up, when they look overseas and find that something completely out of their control is going to dump on us.
Yeah, it is. It's just an added frustration. I mean, for the Reserve Bank, they've had to really pull down inflation over the last couple of years, and we've seen really good progress, 7.3 down to about 2.5%. Now there's risk that inflation reaccelerates this year. We could see it reaching the top end of their target band, which is 1 to 3% in the near term. But, they have to balance the near-term spike against the downside risks to growth, which eventually mean, lower inflation pressures in the medium term. So it's quite a tricky balancing act. And again, we've come off such this experience of high inflation that there's a little bit of, wariness about inflation reaccelerating, a bit of nervousness around rising inflation expectations. So we're a bit more cautious about the inflation outlook than, your textbook usually say to look through this event. But because of what we've come through the last few years, we could see a different play come through out of this.
Have the experiences of the last few years, I guess starting with the pandemic and then unrest and, and now we're looking at nuclear issues, have they changed the way economists look at the world?
I think it just really highlights how interdependent we still are because of the tariff situation.
$900 million roughly in tariffs, which will be paid by US consumers, but it's sort of roughly, you could look at it as a $900 million hit to our export incomes.
We've had to downgrade our growth estimates for New Zealand because we're so, our economic prosperity is inextricably tied to the economic prosperity of our trading partners. So there is still that understanding that what happens overseas is going to be very influential for us down here. So I think in that sense, we are still that conventional play is still what we expect. We're seeing the Phillips curve start to regain a bit of its shape.
What's the Phillips curve?
It's basically the relationship between inflation and unemployment, and it's an inverse relationship. So higher in inflation is usually associated with lower unemployment and vice versa. And we kind of saw that relationship break down during the GFC, where inflation was really, really low, but unemployment was also really low. But now post-COVID, we've kind of seen that Phillips curve regain its shape.
All right, then. Well, that brings us to what is happening within New Zealand. And if I can get you to run us through what we saw last week and explain the anomaly that everyone's talking about, which was that even though dairying is doing really well, it's not pulling up the rest of the economy. What's going on there?
Yeah, it was an interesting print. So our economy expanded 0.8% over the March quarter.
And that was better than expected, right?
Yeah, it was slightly better than expected. We had a 0.7% estimate for that quarter. So it's a relatively decent growth rate over the quarter. It follows a 0.5% increase in the December quarter of last year. So, a pretty strong start coming out of the recession we had last year. But, looking at the details, it showed that growth wasn't as broad-based. Activity across 9 of the 16 industries all increased in terms of activity.
It's not just dairy. Dairy's up $4.5 billion worth of exports to the world. You've got red meat up $1.2 billion to the world. You've got horticulture up over $1 billion. You've got Sesbury hitting $5 billion in this year as well.
Which is good news. But then the bad news is that 6 industries recorded a decline in activity and 1 was flat. So we're not seeing as much of a broad-based growth print as we would like to have seen.
So what are the industries that aren't doing so well?
Arts and recreation was one that led the decline there, which is a little bit interesting because, during the summer period, it's our peak international tourism time, and usually these industries benefit quite a lot. But that one, for some reason, declined in terms of activity over the quarter.
Looks like the people that did the Timeless Summer Tour and Juicy have gone into liquidation. So I think my mum and I paid like $475 for ticket.
The Restaurant Association reported in a recent survey that the main challenges businesses are citing is just customer downturn.
Are we still seeing a post-COVID drop-off, like people who've hung on and then just can't do it anymore?
I think a little bit of that still. We're looking at liquidations and receiverships, and they've started to climb off a very low base. But that's usually the time when, they just can't hang on for much longer, and we start to see that rise. So we are seeing a bit of that happening now. Again, it's off a very low base, so the trend is developing there.
I mean, it used to be the situation that if our farmers were doing well, our country was doing well, but not anymore, right?
Yeah, they are the rural backbone. I think it's just because we've come off, we had a really deep recession during the middle of last year, where I think we're now in a situation where households and businesses are trying to repair their balance sheets, try to get a bit more equity. We haven't seen a lot of activity in the housing market, so that makes it a little bit different. So I think we're just trying to repair our balance sheets before we start to spend and before we start to invest. Business investment intentions is something that we look closely because that really is your source of growth, and we just have not seen much improvement in that space just yet. I think businesses would want to see a more sustained recovery in demand before they feel able to invest again, but that has been something to keep an eye on.
Has COVID made them more cautious?
I think a little bit because we have had such a volatile last 5 years. The economic cycles have been really quite short in that we had a big expansion during 2020, 2021, and then we had interest rates being lifted quite dramatically and quite quickly that had led to a sharp slowdown in economic activity. So I think we've had such a volatile period in the last 5 years, it's hard to find a sense of stability. And then now we're also having to contend with geopolitical risks. So it is, there are risks kind of coming at us in many different directions, just at a time when we're starting to recover. So I think just naturally there is a bit of caution happening.
And will lower interest rates that we're seeing at the moment, will that help give people confidence?
Yeah, I think it definitely will. Lower interest rates will give them a bit of certainty, a bit of support. The cash rate currently sits at around 3.25, neutral cash rate, which is said to be a level where it's not adding to the economy, it's not taking away from the economy, and that level is around 3%, that Goldilocks level. So we're still in sort of contractionary territory in terms of monetary policy. It needs to be a more stimulatory territory for us to see the economy actually pick up and support the recovery going forward.
Can you see it dropping below 3 anytime soon?
Our pick is that it goes down to 2.5%. We still think that the Reserve Bank needs to get the cash rate more decisively in that stimulatory territory to support businesses and to support households through lower interest rates. Markets haven't quite priced it in, so if we do move towards a lower cash rate, we'll see further falls in wholesale rates, and that'll feed through to retail rates, and that'll be a welcome relief for many businesses and households.
Not great for investors though.
Yeah, I suppose it'll be good for investors because once you see lower interest rates, it'll boost growth in the economy, and there'll be opportunities to invest here.
You mentioned housing briefly before, and this is another aspect of our economy that is not running true to New Zealand form. Can you elaborate on what's going on in the housing market?
Yeah, the housing market's been practically moving sideways since it plateaued in May 2023.
Will the New Zealand housing market get better in 2025? Well, house prices have crashed. In just 18 months, they fell 18%. Over the last 12 months, the market has basically gone sideways.
House prices are down slightly, 0.3% on the year. So it really hasn't moved too much. There's been a flood of listings come to the market, and that's keeping a lid on any house price growth. Our call is still that we'll see house price gains this year, about 2 to 3%, as the interest rates that the Reserve Bank has cut, that starts to feed through to the economy in the second half of this year. So it's just been really, really quiet in the housing market.
Is there a different attitude in the housing market? Because that's quite slow, isn't it? Usually we're all great guns on housing. It drags up our figures, our productivity figures.
Yeah, it is. I think it's just that, we've seen house prices rise 46% during that COVID pandemic, and it's fallen about 17%. They're still at levels higher than pre-COVID, so it's still quite difficult to get into the market. But also, we haven't seen many investors come into the market. We've had a few policy changes around bright line test and interest deductibility that's really sidelined many investors. We haven't seen much activity. In fact, most of the lending going out has been to first home buyers, and we haven't seen much in the way of investor activity. So I think that's one aspect that's keeping a lid on house price growth as well, just that lack of activity. They're probably waiting for more interest rate reductions to come, also trying to repair their equity before they decide to jump back in, and then we'll start to see house price growth. But that one sector or segment of the housing market has been quite quiet.
So we're talking about landlords being scared off a bit, first by Labour's changes and then reluctant to dip their toe back in?
Yeah, it's not usually the case where we see most of the lending going out to first home buyers, where investors are typically the market. But we've seen that reverse. We are starting to see them come back in. I guess nearing the end of the interest rate cycle, they're starting to dip their toe back in, but I think that is one of the reasons why we've had such a subdued housing market, is because that segment of the market has been quite quiet.
The government is trumpeting the latest GDP figures, which show the economy grew by 0.8% in the March quarter, higher than expectations. But one economist is urging people not to read too much into those stats because they predate Trump's tariffs and the Iran-Israel war. Kiwi Bank's Jared Kerr says they also reflect two different economies, one rocketing and one fizzing.
Households are fighting their way through a cost of living crisis. Now they're worried about their jobs, and they've seen their hours worked decline 3% over the year. So, there are large parts of the economy, including retailing, that are struggling to get out of the recession of last year.
Commentary from several different economists has talked of a tale of two economies emerging with these latest figures. What is that all about?
Yeah, it's right what you were saying earlier, how, our primary industries, dairy farmers, they're doing really well because of strong export prices, and they've had strong volumes as well. And the Kiwi dollar was a little bit weaker at the beginning of the year. So that's been a kind of perfect storm to really boost our rural regions. But then, because of things like the housing market being quite subdued and our net migration numbers kind of falling away and really cooling off, we've seen our urban centres not perform as well. So you're seeing this kind of two-speed or two-tier economy develop, and it's really stark. You'll start to see how consumer behavior or consumer spending will be different across the regions. More money in the back pockets of farmers could see a bit more spending in the rural regions, but then with a subdued housing market in our urban centres, it does put downward pressure on, or a reluctance for consumers in our urban centres to spend.
So, is our economic recovery about to lose steam?
We've had a strong start to the recovery coming out of recession last year, but the more timely economic data indicators that are coming out are showing that growth might not be repeated in the current quarter we're in. We might see a slowdown in economic activity in the June quarter. Things like PMI that's returned into contraction territory after being signaling 4 months of being in expansion. You look at retail card spending, that's also been practically tracking sideways. So we may not see, the 0.8% growth that we've seen in the March quarter repeated in the current quarter, and we'll see that slow down in the sort of winter months before we see it increase again.
Is there a main factor in that?
I think it's the uncertainty of the current environment, and we see a bit more uncertainty really weighing on decisions, and that uncertainty really stalls growth. And that global trade disruption, we're very much influenced by it, so we could see that activity across many sectors kind of slow down this winter period. It's another reason why we need, more interest rate relief from the Reserve Bank to add a bit more certainty in this uncertain time. I think we are, knock on wood, the worst is behind us. That recession we had last year was very deep. A cumulative 2% decline in economic output over 6 months is quite deep. And on a per capita basis, things look even uglier. And I think it almost rivals or is even worse than the GFC. So I think the worst is behind us. And we've had a lot of rate cuts from the Reserve Bank that still have to feed through the economy. So we are expecting, growth this year, just maybe not as strong as we had expected at the end of last year.
With a few headwinds that we couldn't predict.
No, exactly. Yeah. And there's probably more to come.
Last week, from Monday to Thursday, being Friday was a holiday, we saw a huge amount of financial information coming out. Of all those figures, what is the scariest one? Which was the one that you thought, oh, that's just not good?
We've had quite a mixed bag of data in the last few months, kind of telling different things about, different sectors of the economy. I think the one that really sticks out from last week is just that price indexes showing that inflationary pressures from offshore are starting to heat up. Food prices are up 4.4% over the year. Butter, if you look at that, it's doubled its price over, I think it's up 50% or something over the last year. So those kind of things are unhelpful for our inflation outlook. There's some good news around domestic inflation coming. Rents were up just 0.1%, which is quite weak. So that helps there. But I think the one that really sticks out is that inflationary pressures from offshore are starting to lift, and we could see that flow through. We could see another hot print this June because of the rising oil prices. So I think that's one that really have to keep an eye on.
There was another report out last week that slipped below the radar a bit, perhaps because it largely repeats what we already know. The IMF says our productivity is poor, and it has been for a long time. Mary Jo says it's a big issue and it's holding New Zealand back.
We're lacking in terms of capital intensity. We have many issues around infrastructure really holding us back. We see a cyclical rebound for the New Zealand economy, but it's heading to a long-term growth rate of about 2.5%, which pales in comparison to many other of our trading partners. And what's holding us back in terms of our long-term growth is really around our productivity and the lack of, infrastructure spend to get us to become a more productive economy that really does hinder us in terms of the long run.
That's got to be a government decision, doesn't it, to actively invest in infrastructure? I mean, you're talking about if you build a new harbour bridge, it's not small beans.
Yeah, it is. And this is a sort of criticism of both governments. Really, it's that we haven't seen enough infrastructure spend in the last in decades. You can see that our capital investment has been really low. And it's just that really does hold us back in terms of the production, the potential that we could have as an economy.
Because a lot of the narrative is around, oh dear, this is costing so many billions of dollars, we shouldn't do it. And New Zealand is scared by big figures. Should we be saying, wow, this is costing billions of dollars and it's going to get the economy moving?
Yeah, I mean, we've seen our debt to GDP ratio really increase over the last few years during COVID, understandably, as the government had to support the economy. But, a high debt to GDP figure is not an issue when you're using that money productively and when it goes into productive assets. And we could see that ratio increase. It's nothing near as what we've seen in other countries. And we could see our debt grow so long as it's, good debt that we're doing goes into infrastructure, goes into hospitals and roading and transport. That stuff does pay itself off. Higher debt to GDP is not so much of an issue if it's being spent correctly.
That's it for today. The Detail is a newsroom production supported by RNZ and New Zealand On Air. This episode was produced by Gwen McClure and engineered by Phil Benge. Thanks to Mary Jo Vergara. I'm Alexia Russell and we'll be back tomorrow.